Welcome to Custodian Financial Group's purpose-built congregation sustainability model. This tool has been specifically created to provide guidance to individual congregations on whether their existing capital and financial resources can support the needs of its members over their lifetimes. This can produce insightful short and long-term outcomes and provide a basis on how the congregation manages their money going forward. Furthermore, the modelling can determine the opportunity and impacts of using capital for missionary purposes or any other purpose for that matter. In our experience when dealing with congregations, we have found that a lot of times the congregation is focused on day-to-day outcomes, without any real idea on how they may be positioned in 10, 20 or even 30 years' time. This is where our sustainability model can provide some fantastic insight. To demonstrate the outcomes the modelling can produce, we will be taking you through a brief example for an imaginary congregation. This will involve the input of some very fine detail, however, will culminate in a very simple and easy to understand graph showing the congregation's capital position over the future and if or when the capital may be extinguished. With regard to inputting the fine detail, you can see that we record the congregation's assets, the historical performance of those assets, but most importantly, the details of each and every member of the congregation. In order to project the sustainability of the congregation, we need to know the ages of all of the members and their projected life expectancies, which is detailed on the age data screen. Here we have a congregation of 35 sisters, ranging from 1 being the eldest sister to 35 being the youngest sister. Now we use this information to calculate the life expectancy for each and every sister. Now we've undertaken some extensive research which indicates that the average member of a congregation can expect to live approximately 20% longer than the general public. And so we actually use this as the true life expectancy for the members of the congregation. Now that we have this information, we can actually calculate the projected income and expenses for the congregation each and every year. First of all, we have the age pension payments. And you can see here that the 30 eldest sisters are each entitled to the age pension and the 5 youngest sisters aren't yet of age pension age. And this gives us an idea of the ongoing Centrelink support that the congregation receives. As we move forward, you can see that in future years the youngest members of the congregation eventually become entitled to the age pension and the eldest members of the congregation are projected to pass away and therefore the congregation no longer receives that additional support. For the community expenses the congregation incurs, in this instance we have assumed an amount of $18,000 per year, indexed with inflation, for each sister living in Australia. So in this instance we have several sisters who are actually living overseas and as a result are not included in the ongoing community expenses. Next we have the working age sisters living in Australia, and this gives us an idea of the capacity those sisters can help with administrative costs and aged care costs and things of that nature, and helps us work out the shortfall for the congregation and how that shortfall might be covered in terms of employment costs. Now that amount will change year on year, and once again that cost is an ongoing amount that's calculated in the modelling. Next we have the sisters living in Australia, and as we discussed earlier that is used to calculate community expenses, but it's also used to determine which sisters are entitled to the rent assistance, another payment received from Centrelink. We have the sisters beyond working age, who are those sisters who might be in some need of aged care support, and we use some very tailored and very sophisticated research to determine what that could look like. Now we could go on and on and on with the specific assumptions we've used, but rather than do that, we'll have a quick look at the assumptions. And this is a quick snapshot showing all of the assumptions that we take into account. Now first of all we have the investment returns for each asset class, and we use this amount to project the ongoing capital of the congregation's assets. Now these amounts are based on historical returns for the last 25 years over a period which is reflective of today's economy. Now as we scroll down further we have indexation, once again is taken over that 25-year period, increases to employment wages over that time frame, which is used to determine the increase to the congregation's employment expenses. The income, you can see here we have the age pension for those sisters of age pension age, the rent assistance for those sisters who are also living in Australia. We have an assumption for stipends here, which we've assumed is going to be reducing every year by 10%. Rental income, interest and other income. Really, we can take into account any assumption that we want that's specific to the congregation. As far as community expenses go, we have the $18,000 that we discussed earlier, but we also have a contribution to the general of 2.5% of that amount. And further down, we have the employee and other expenses, which we've touched on briefly. And we've also included in this scenario an assumption that this congregation will actually sell convents in future as they are no longer required. All of this information is encapsulated in the cash flow and capital graph. And you can see that there's quite a lot of information that goes into this graph, including the income of every item for each year, the expenses for every item for each year, as well as lump sum income and expenses. Now, rather than go through each and every line here, as you can see, it's quite cumbersome and quite burdensome for somebody to look at. We actually use this information to come up with a quick and easy capital graph. Now, in this instance, the congregation is actually projected to meet its requirements until the year 2050, which we've just used as an example in this scenario. But we might want to look at various scenarios, and let's say that the congregation wants to know what the impact would be of using $2 million immediately for missionary purposes. Under that scenario, we can simply plug that number in, and we can see that the congregation is now projected to run out of capital between 2049 and 2050. Now, in this instance, that might be a mandatory expense that the congregation needs to incur, in which case we need to find another way that the congregation can meet its requirements. One option could be to actually increase the growth profile of the investments that the congregation holds. And if we actually look at a more aggressive investment option, we can see that now the congregation is projected to have sufficient capital to provide for its lifetime. And this is something that we can actually assist the congregation with. Now, there's an endless amount of scenarios that we could take into consideration, and each and every one is different for each congregation. So rather than go through all of the specifics today, which we just simply don't have time to do, if there is a scenario that you would like to consider, or there's a number of scenarios that you believe relate specifically to your congregation, we would love to discuss those with you further, along with the aid of our modelling. If this is appropriate for you, please feel free to call our office on 02 6162 1871, and we would be pleased to assist. Thank you for taking the time to review our congregation sustainability model.